Foreign reserves serve as a crucial indicator of a country's economic strength and stability. They enable a country to purchase goods and services from other nations, including vital manufacturing equipment. Moreover, foreign reserves facilitate the repayment of foreign debts, which is essential in today's interconnected world. Therefore, a country's foreign reserves play a pivotal role in its economic well-being. The greater the amount of foreign reserves a country possesses, the stronger its economic position. This brings us to Malaysia, a highly successful nation in Southeast Asia, ranking just behind Singapore and Brunei in terms of per capita GDP. Despite the region's numerous challenges throughout the 20th century, Malaysia has emerged as a prosperous economy and a significant player in the global arena. Hence, one would expect Malaysia to have abundant foreign reserves. However, let's examine whether this is truly the case. Before we delve into Malaysia's foreign reserves, let's quickly recap what foreign reserves are. Foreign reserves are assets held by a country's central bank or government in foreign currencies, gold, or special drawing rights issued by the International Monetary Fund (IMF). These reserves act as a financial buffer, helping countries weather economic shocks, stabilize their currency, and pay for imports, among other purposes. Upon understanding that, let us understand how big Malaysia's foreign reserves are. As of the latest data, Malaysia's foreign reserves stood at approximately $115 billion. However, it's important to note that this figure is subject to change due to fluctuations in exchange rates, investment returns, and other market factors. Comparatively, Malaysia's foreign reserves are considerably smaller than those of its neighboring country, Singapore, which has amassed foreign reserves of around $310 billion. Thailand, which sits at $224.5 billion, and Indonesia at $139 billion. It is only higher than both the Philippines, which has $100 billion, and Vietnam at $83 billion. Comparatively, therefore, Malaysia sits in the middle. It is also worth pointing out that Malaysia's foreign reserves have been way higher around the early 2010s, reaching nearly $160 billion. As a result, however, of declining oil prices, which are a huge part of the country's overall exports, capital outflows, repayment of external debt, and currency intervention, the country's foreign reserves has dropped to where it is today. So what are the factors that contribute to the size of Malaysia's foreign reserves? Let's explore some key aspects that have influenced its foreign reserve accumulation. The first comes from international trade, or specifically, Malaysia's exports. Malaysia's exports have played a significant role in the accumulation of its foreign reserves. The country's exports include electronics, petroleum, palm oil, and rubber, which generate substantial foreign currency earnings. As these earnings accumulate, they contribute to Malaysia's foreign reserves. An illustrative instance in this context is when Malaysia exports electronics to other countries, earning foreign currencies, which are typically in the form of US dollars. Secondly, Malaysia has established itself as a key player in the global financial market with a well-developed financial sector and a strong presence of international financial institutions. This has resulted in an increase in foreign currency deposits and investments, which have boosted the country's foreign reserves. Thirdly, Malaysia has a sound fiscal policy that has helped to maintain macroeconomic stability, including a managed exchange rate regime. This has attracted foreign investors, resulting in a steady inflow of foreign capital, which has also contributed to the country's foreign reserves. Finally, there are also very small factors that contribute to the overall foreign reserves. Some could come from service exports to foreign remittances, and even prudent financial management practices from the Central Bank of Malaysia. As we move forward these factors of contribution, we must then understand just how important these foreign reserves are at play in Malaysia's overall economy. To begin, we consider an economic indicator known as total reserves in months of imports. This metric represents the number of months that a country's foreign reserves could sustain its imports. It provides insight into a country's ability to weather economic shocks and maintain its trade relationships with other nations. As of 2021, Malaysia only has 5 months' worth of total reserves. Comparatively, this is lower than most Southeast Asia's biggest economies. Only Vietnam trails with 4 months. Furthermore, It's crucial to highlight the magnitude of Malaysia's total external debt relative to its foreign reserves. According to the latest data, Malaysia's external debt amounts to approximately $259 billion, which is more than twice the size of the country's total reserves. However, it should be noted that not all of its external debt is due for repayment within a year, or short-term debt, as a significant portion consists of various factors such as long-term debt or foreign deposits. In addition to the factors previously mentioned, foreign reserves play a crucial role in Malaysia's economy for various other reasons. One of the primary functions of foreign reserves is to maintain the stability of the country's currency. By having an adequate amount of foreign reserves, Malaysia's central bank can intervene in the foreign exchange market to prevent sudden and drastic fluctuations in the value of the Malaysian ringgit. This, in turn, helps to maintain investor confidence and stability in the economy. Foreign reserves also provide Malaysia with a buffer against external shocks, such as changes in global commodity prices or sudden capital outflows. With a sufficient level of foreign reserves, Malaysia can mitigate the effects of such shocks on its economy, enabling it to recover more quickly. To gain a deeper understanding of Malaysia's foreign reserves and their importance in the economy, it's crucial to examine the country's experience with past financial crises, particularly the 1997 Asian financial crisis and the 2008 global financial crisis. These crises have shaped Malaysia's approach to foreign reserve management and provide important lessons for other countries as well. Let us begin with the Asian financial crisis, which began in July 1997, when the Thai baht collapsed due to a lack of foreign currency reserves to support its peg to the US dollar. The crisis quickly spread to other Asian countries, including Malaysia, resulting in severe currency devaluations, massive capital outflows, and economic contractions. Malaysia was hit hard by the crisis. The Malaysian ringgit lost more than 40% of its value against the US dollar, and the country's foreign reserves plummeted. At the time, Malaysia's foreign reserves were insufficient to defend its currency peg, forcing the government to abandon the fixed exchange rate regime and implement a series of controversial capital control measures. The crisis exposed the vulnerability of Malaysia's economy to external shocks and underscored the importance of maintaining adequate foreign reserves to cushion against such events. In response, Malaysia adopted a more proactive approach to managing its foreign reserves, focusing on building a financial buffer and enhancing the nation's resilience to economic shocks. Following the 1997 crisis, the 2008 global financial crisis had helped segment a new Malaysian economy. When the US housing market collapsed, it had far-reaching consequences worldwide. Although Malaysia was not at the epicenter of the crisis, it still felt the ripple effects, as the crisis led to a global economic downturn and a significant drop in demand for the country's exports. However, unlike the 1997 Asian financial crisis, Malaysia was better prepared to weather the storm. Thanks to the lessons learned from the previous crisis and the prudent management of its foreign reserves, Malaysia was able to mitigate the impact of the global financial crisis on its economy. The country's foreign reserves provided a much-needed financial buffer, allowing it to maintain stability and avoid the need for drastic measures such as capital controls or currency devaluations. The final aspect here is the country's central bank, Bank Negara Malaysia, plays a crucial role in managing the country's foreign reserves. BNM is responsible for implementing monetary policy, supervising financial institutions, and ensuring financial stability. In the context of foreign reserves, BNM's primary objectives are to maintain exchange rate stability and ensure sufficient liquidity to meet the country's external obligations. To achieve these goals, BNM employs various strategies such as intervening in the foreign exchange market, managing the country's gold reserves, and investing in foreign currency-denominated assets. These actions attribute to the overall size and composition of Malaysia's foreign reserves. In conclusion, Malaysia's foreign reserves, which stood at around 115 billion US dollars as of the latest data, are the result of various factors, including its export-driven economy, the pursuit of currency stability, and lessons learned from past financial crises. Bank Negara Malaysia, as the nation's central bank, plays a pivotal role in managing these reserves and ensuring the country's financial stability. As we've seen, Malaysia's experience offers valuable insights for other countries seeking to build and maintain foreign reserves. By focusing on diversification, learning from past crises, and recognizing the crucial role of central banks, countries can better position themselves for sustained growth and economic resilience. But anyway, do let us know what you think. Thanks for watching.